They are. So let's just put this in perspective. Markets going up, but wage growth is not keeping pace with the kind of inflation that we are witnessing here in India. For that interaction, we are joined by Soumyajit Niyogi, Director at India Ratings and Research, along with independent market expert Mahantesh Sabarad. Gentlemen, thanks so much for joining us. First to you, Soumyajit Niyogi. We are seeing this kind of scenario emerge where inflation is a continued concern for the RBI. Wage growth is not keeping pace as we understand it by this ET Prime research which has been done between 2018 and 2023. In some of the sectors like manufacturing, there is a shrinking as well. And IT sector, which is of course a proxy for the services sector, we are seeing it just about do okay in the sense that wage growth has not been phenomenal. Why do you think this is the case?
Yeah, thanks, and very good evening. I think two, three reasons. So one reason is definitely that's one of the softer aspects that the corporate can maintain profitability by keeping the employee cost lower. That is one. And the second, two things are happening. One, the enough job creation is not happening. At the same time, the AIML fear is actually spreading. So that's giving another lever to the corporates to keep the wage growth rate low. And if you look at the overall top line growth for last 2 quarters, it seems to be single digit to maximum high single digit. Whereas if you see the profit growth, it is higher. So within the cost structure, if you bifurcate between the employee costs and non-employee costs, if you talk about the fuel and power cost, it has gone up. Oil price has been higher, and so has the electricity prices. Overall, because of the inflation, the sales and distribution cost is slightly higher. So that's, you are mostly, the corporates are mostly taker. They can't do much barring the large corporate. So this is the one employee cost, which is actually, it's the large levers available for the hands of the corporate, most of the corporate. And they are just actually squeezing as much as possible. Where the competition is not much, losing the key employees not much. So they are trying to maintain their operating leverage by keeping the employee cost and whatever possible discretionary cost lower.
It seems to be the case. Right now, Mahantesh, inflation is something we talk about just about everywhere. We speak about valuations as well in the markets, and that certainly is true about certain stocks when we talk about them being too expensive to buy. When you make a comparison, when you see earnings reports and you see the cost companies on the wage front and you compare it to their profitability and then consider how well that stock has done in the equity markets, what is the trend that you observe? Have you seen a mismatch?
So basically, one can clearly observe that the corporate profitability is on the rise, and that corporate profitability is on the rise despite having lower sales growth. That is what Niyogi also talked about. So what we are seeing is that the rise in corporate profitability, rise in margins, rise in both at the operating level and at the bottom line level, is helping fuel a rapid EPS growth. One part of that EPS growth also has been contributed by lower taxation aided by lower corporate tax rates. So I think what therefore has happened in the last few years is some of these corporates' profitability being better, the valuations are rising quite sharply. And in the interim, and particularly in the past 7-8 months, we have seen interest rates actually halt in terms of their rapid climb, although the inflation has not been tackled conclusively, but there are already expectations getting built that says inflation will be tackled soon, and therefore overall interest levels will sharply start going down. If that is the case, the valuation further enhanced, because your equity yield that you get from rising profitability becomes better relative to the debt yield. That which is determined by underlying interest rates. So therefore, you are seeing markets actually pricing in better equity yields through valuation gains. Corporates are able to do better profitability through several levers, including employee cost being one of them, but tax lever is one major one that is happening. And if this is what the mismatch that you're talking about, then that is what the reality is. It's a mismatch which we haven't seen before.
Is there a price to pay for this kind of mismatch, Soumyajit? How do you see high inflation and the relative low growth in wages affect the way that Indians live? Because there is bound to be an impact on credit growth. And when credit growth is towards personal loans, something the RBI is trying to keep a check on with these new norms, there is going to be a natural fallout because savings are going down in Indian households. Retail debt is increasing sharply. So what is the price one has to pay for this kind of mismatch as you see it?
Right. So first of all, it cannot go for long. So one thing is that like when the employee cost is low, as my colleague rightly pointed out, that is actually keeping the EBITDA growth rate intact, and that is also fueling valuation. Though I'm not going to talk about the equity valuation. At the same time, when the inflation is higher, your real wage is actually coming down, and inflation is higher, your interest rate is going high. Obviously, your real wage is lower. At the same time, your financial burden is increasing. And that is my belief, somehow creating a pressure for the household to look for alternative option where it is not easy. So people are looking for more into a stock market. So just to generate some side income so that they can compensate their fall in income, and they can actually enjoy whatever they wanted. Now the question is that without concomitant rise in recovery, which is recovery in revenue, and which is largely lagging because of the consumption growth, is no way recovering as expected and as compared to the other constituents of the GDP. If the consumption growth doesn't go up, the revenue will continue to show sluggish trend, and this trend will face a challenge in near term, particularly in terms of the housing, in terms of the household debt, one. And second, obviously, the pressure that the household is going to face, they will have to cut down the expenditure, discretionary expenditure, whatever best possible way. So that's both the situation. It's not a very benign or not a very conducive. Rather, it can actually trigger some more problem.
Mahantesh, how do you see discretionary spends? Because among several market watchers, they are pointing at rising discretionary spends as the reason why you should get into certain sectors, certain themes into the markets. Even as we see these SIPs on the rise, it seems quite clear that retail investors, they're preferring to save less and they're trying to invest more. And like Soumyajit is pointing out as well, they're trying to get this side income going. But obviously, low wage growth also means it's going to have an impact in the equity markets. Is that coming too?
So, fortunately, most of these companies that you're talking about in terms of consumer discretionary spends are into the premium segment. So, it's not really rising consumer discretionary spends, it's actually rising premiumization that is allowing corporates who operate within the stock market zone take up customers or look for customers who ask for premium products. So you find, therefore, take automobiles, for example, you therefore find that the sales of top-end SUVs or top-end cars actually go up relative to the entry-level segments. Same is the case with two-wheelers. Same is the case, let's say, with even housing, purchase of houses. So all discretionary spends that you're seeing is showing a dichotomy in terms of the premium segment going far too excessively to the discomfort of the lower segment or the entry-level segment kind of consumer spends. Corporates within the stock market realm are really happy with this premiumization trend because that allows them better profitability margin for the time being. They do not cater essentially to the lower end kind of segment. That is why you find iShare, like Enfield motorcycle maker iShare, commanding a premium relative to, let's say, a Hero MotoCorp that's into entry level bikes. So this is exactly what is happening right now. The household spend is a mass effect that is not affecting the premium segment sales or the premium segment consumption.
So then going ahead, because of the kind of trend that I'm seeing in the US, Soumyajit, and going by what Mahantesh is pointing out as well, the kind of data for the US that I'm looking at shows that while inflation is high in that market, wage growth is higher than inflation. This is being offered as one of the reasons why the US may not actually hit recession. Tell us about the Indian story, because as far as this ET Prime article goes, they are looking at inflation itself posing challenges to households in servicing debt. And add to this, the slow wages can make it doubly difficult, wouldn't it?
I think so. So the thing is that if you compare with our situation with any other country, particularly European country or US country, wherever we are seeing that there is a serious dent in the consumption, either the household rate has increased post-pandemic or the income certainty has come down definitely. And if you compare with the US, compared to any other country, their household debt, household balance sheet has improved in a meaningful way. And that is actually giving the big trigger to the resilient consumption. Whereas if you compare with the China, if you see this, the household savings is falling and consumption, it is also following the same trend. And for us, it is still holding up. But the point is that, like, if it continues for some more time, so one factor is definitely would start affecting is the bottom of the pyramid consumption. Again, I fully support that argument that the K-shape or the premiumization is very much in place. So the bottom of the pyramid, if continues to face challenge, some way the dichotomy would end. Either the bottom of the pyramid would have to catch up, or the top end of the pyramid would have to show some kind of the moderation, which could be possible in 24. The lag effect of the higher interest rate, what we are seeing is that, and plus the tightening RBI has started, other than the interest rate, they have tightened the risk weightage norm, could pinch some of the borrowers, and finally that could actually moderate that overall household debt or the retail loan what we are seeing.
Point out that these are the pangs a growing economy is going to face, and something that is most evident, the lack of real growth when I talk about wages and the kind of upsurge we are seeing in the markets, perhaps built on expectations on how the economy is going to grow. But when it's consumption-led, that is the worry area, because consumption depends a lot on how much people are able to save. And if wages aren't growing enough, then people aren't saving enough. But a lot is getting pumped into the equity markets right now, as the SIP pictures show. We'll keep tracking this, but thanks very much, Mahantesh and Soumyajit, for talking to us about the practical reasons why this is happening right now. Thanks indeed.